Good afternoon, traders. Jeff coming to you from Full Throttle Traders. I want to take a few minutes today, it's on Saturday, March 15th, and review a little bit of the past week. It's definitely been something to remember, the way the market has just taken off, and moved us into correction territory, at least as of Friday prior to the bounce. We're going to cover all that and more on a trade alert that we did on the day trade side in the morning, and really just kind of yank some cool profits out of Dell. Stay with me. We're going to review it all. All right, Jeff, back at you here. Again, for those of you that may be new to the channel here, 22 years, option stock specialist. Started here just really before we even went to decimal points here. And over the years, traded and on my own. And now we do have a room at Full Throttle Traders since last April here. So you can always join this as the Discord group. You put your charts throughout the day, plays and things like that. So check it out if you're interested. Let's talk about today. This week, really, the market, the one-day performance, I want to kind of put them all three here together just to let you see the change. Well, the obvious thing that comes to mind is everything was great on Friday. We'll go through the chart more specifically on that, but that's no surprise. Market was up a great deal. I think as a matter of fact, the top to bottom of the SPY was about $12 as the VIX was falling. But the thing I want to point out here is that we've been really in I've been talking about the sector rotation, mainly centered around technology and financials. You can see here the month up to date, you can see is over 10% down. Was over 10% down in the technology. And then we look just at last week specifically, we began to lessen that loss, right? So from a 2-week perspective, we were definitely able to cut that back to about 2.5. And then looking at on Friday, really kind of granular, you can see tech led the charge back up, making up more than the week's low, and then cutting drastically into the month, because the month was just horrible in the way that it unfolded with some of the sell-off that came in. Again, tech, you've heard the old saying, the bigger they are, the harder they fall. And tech has had such a run, whether it be just technology in the XLF or just looking at the SMH and semiconductors specifically. Nonetheless, technology has been up there. A lot of talk and hype centered around AI, and that has definitely brought this too. So some of this was just, trimming the crop a little bit, taking some profits up there where they should be taking some profits, pairing some of the trade-offs. So you have a mixture of that rotation, but also just people wanting to take that money, let that pullback happen. They'll re-enter on the pullback and put that to work elsewhere. So it's kind of what you're seeing right now in the markets. Let's take a look at, I'm going to go through one specific trade that we took on a Friday. Remember, in the morning in our trading room, we get out, we trade for about an hour and a half in the day trade side. We typically trade stocks, and we're trading them off of very short time frames. The master time frame, the multiple time frame has to be there, but then we're focused in on the gap list and then what we can find in the intraday. We do that in two different ways. We do that off the early part of the morning in a very scalp-minded way, where we're looking for 2-minute charts. We want to get that thing down, make a half bar, go break even. Sometimes if you get in early enough, you can get 4, 5, 6 R out of those bigger trades if you let it go that far. But the danger side of that is that you're in too early. If they get in, they break the barrier, and then it pulls right back on you and stop out pretty fast. So we don't want to do all of that. So we want to cut our risk back in half, and we do a couple of those trades, 2 to 3 trades in one is what our attempt is. And then once the market settles and the stocks that have flourish either higher or lower, and then we're looking for pullbacks on the day trade side. Now, this is where you can make a lot more bang for the buck. Now, keep in mind as I go through this, the most at risk that you'll ever had trading this system that I have is about half risk. So if you're risking $100, the most you can risk is $50. However, because the way we're looking for 4R targets and the way we're trimming along the way up, you can also make about 3R. So you can have a 3R win potentially, which is what Delta will end up being, a 4R, but our risk is only, down here at 1/2 of an R. So once you get it scaling, the risk reward is great. Now, one of the reasons I like doing pullbacks, because we can usually use less of a stop. What I hate about doing breakouts too late is that if the market ran up or the stock ran up more specifically, and then the average trading range was exhausted, whether there's room above or not, it's harder for that hit. So it's hard to add to the model. Our model is the pullback. We've taken a lot of this back in the pullback. was able to get on some sort of a buy setup, and even more so, more of a pullback. So you hear about getting in buy setups. I agree with that. I definitely would do that. But I'm trying to get in at a pullback level. Now, the danger, or maybe the kind of the challenge you can go through when you're doing that, is they don't quite pull back to where you're looking at the Fibonacci's and things like that, which I'm going to show you. So you have to alter a little bit more of a method. You've got to be able to have the pullback, determine that stock. If it doesn't quite hit your entry point, at some point, you've got to relinquish to getting in at the higher point, keeping the stop the same, reducing the shares to keep the overall risk at the same level. I'm going to go through that here momentarily on Dell. Now, this is Dell. I want to kind of give you just a snapshot here of how we entered the trade. This is based on a full risk. We cut these risks down to about 50%. The market's been crazy, but everything being the same, $1,250 on Dell. And here's the thing. Dell has been volatile. It's been up 160, 70 bucks. It's been down to what, 75 bucks. So we took this in, and what we're looking for is stocks that are on the gap list initially. And if the market's coming in, we want to see what's holding up. We call that relative strength. But right about 10 o'clock, I start getting serious in my pullback trades. I want to see what happens at the 10 o'clock hour. That would basically the 30-minute high, the 30-minute low. And I want to see what's holding up. How did it hold up against the market? Was it relatively strong against the market? Was it weak? Was it neutral? Was it just like the market? So we're identifying all those factors. And again, I'll go to the bigger chart here in a moment and show you, but I want to kind of lay it out this way, at least that I have them all drawn out. So once I determined that Dell is an interesting stock, it's holding up well, it's trading pretty clean. I see some tails coming in. It's got room to the high side, nothing to the left as far as supply. I'll put the Fibonacci lines on the open to the high, which is typically around just before, or I like to do it just after 10 o'clock. And what I want to see is that when this thing pulls back, I don't want to see this. You saw what happened on Friday. We had a big, huge $4 rundown instantly, right? Dell wasn't participating in that as well. I want to discard that, make sure the stock gets back up. And if you notice right in here, I wanted to see how the pullback was holding. The tails were there. I drew the Fibonacci lines, and right here at the green line, it's a 50% Fibonacci within a penny or two. So I told the trading member, I said, look, we're going to get in this here. If we get the pullback to 50%, what were some of the negatives? Well, in the magenta line, colored line here, the purple line, we were just getting below the area. We're also below the 9 EMA on the 2. Now, I typically like to trade above those, but in stocks that are holding up better than the market, or at least, pretty resilient from what I can see, I will take that earlier entry below the area on a day trade. So when it pulled back to these areas, we're able to see, if I could have got in right here on the little buy setup that ended up failing because it took out the low here, I would have been in around 96.25. So I would have had a 75-cent stop in that. And I don't have quite the odds of hitting my 4R target, which is what I'm aiming for in this particular type of venue. So as I pull back in here, I was able to get in right at 95, right? And when it did, it pulled back here to only 15 cents, right? So I want to see what's the top ranging, where is 75% of the pullback, and that was only 94.74. I went beyond that. I went down to 95.50. I'm sorry, 94.50. I was down here about 80%. And I knew that if we failed down below 75, game over. The thing wasn't going to work anyway. So we were able to keep a tight stop, a relatively clean state trading stock. Again, tech was up that morning. The morning the market, first time, it did not just give back $9. It held to some reason here other than this little 10 o'clock reversal time. And this is basically on the Michigan consumer sentiment numbers. So we were watching that too in the room. I put out an earlier announcement that be careful right at 10 because you got the Michigan numbers coming out. We're always very coherent into those numbers and what's coming at particular times, as well as Fed speakers. Nonetheless, we entered right here. We had to stop at 94.50, and I drew that line right here at 94.50. It's basically near the bottom, but it was only 50 cents. So I knew that we had a better than average chance of making the money. So we got in here. We were able to get this thing up, run up, came back down, did not stop us out, kept going in here, and we were able to parse a little bit here at 1R. We took a little bit off the table, and we ended up taking our 4R target right here, and that was exiting right at 97. That was about 97 right there. Now, we could have stayed in, and what would have happened? It did pull back hard, just got some people selling their positions because of a stout move. So again, in this example, on a full risk model, you would have had a 250 risk with a 1250 gain. right? And really it was a little bit more. I did this at 2.5 risk. It really comes out to about 2.8, call it 3R. This is figured at about 2.5. Here a little less, we took a little less. So you can get an idea. This is probably closer to $1,500. So imagine having a process or a strategy that allows you to have a 250 stop, but if it goes with the ad, it could be around $1,500 or so or better. So you could have like 6 to 1. So if you have 6 losers and 1 winner, voila, you're break even. That's a great strategy because we're trying to find the ones that have the most potential. We're going in half risk and then we're adding. So let's move on to the charts here. Now, if you notice on the gap up list in here, Dell was not on that list. Let me actually kind of take the this off of here and this off of here and keep this a little cleaner. Dell was not on the gap up list. So we exhausted the opportunity in here. Like this IONQ trade certainly was on the gap list here, but there was no entry because I'm looking past 10 o'clock. And by the time 10 o'clock happened, I drew the fib lines. It was quick to the bottom to the top and just didn't have any stance. In hindsight, yeah, the double bottom at the 50% would have worked, and that would have got you in around 23.25, 25.02. That's a nice little profit based on the stop there. But when I was looking at it, and sometimes it's just in the middle of everything, you start looking at a bunch of stocks. I was trying to find something that might give us an edge. MU just pulled back. The Shopify, right? This is fresh off of earnings, I believe. That wasn't that one. You can see really no pattern in here. They all pull back on consumer sentiment and bounced one, but it bounced to a lower high. And then, of course, so I started scanning through the S&P 500 here, and I came across the good old Michael Dell stock. And again, first thing we're doing is we're making sure that we are moving higher. Now, everything, the patterns have been to the long side, if you're going long, has been off the double bottom bounce. That is a pattern. It's been more climactic drops that actually have into support than maybe a retest and then the higher break. Those have been the most dominant here. Now, if you notice Dell, I was talking about with the room members, what I'm interested in is that I want to see the ones that are gapping up, gapping over a red bar, ideally a longer red bar to trap the shorts. In this one here, we had a little bit more of a tail, not as much, but what did Dell have going for it? Well, it was gapping up over to and through the 8 periods, which is the dotted line, the 8 EMA. I like that. Now, a lot of these other stocks that were gapping up, this one actually was, but it didn't have the pattern. Like I said, MU was just already up here too far in the bars. This was gapping down up, but it was gapping down under the 8, which is still fine. I'll still take the scalp, but I'll get out a bit here. This was gapping down below in Ulta. Now, that's a high dollar stock, but it also worked as well. So going back to Dell for a second, you can see the gap was good. And again, what I did after 10 o'clock is that I said, okay, I landed on a stock that I felt comfortable with. I drew the fib lines in here and I put this down here and I ran to the top. Again, I'll do that right now just to kind of show you the process, right? You can do this day in and day out to find these opportunities in here. Again, do all of them work? I would lie if I said they would. They don't. But if you want the better chance, what I'm looking for at this point in time is relative strength and or relative weakness, clean trading, how's it holding up against the fib lines at the 50 level? You see the tails coming off, and at this point in time, holding on to VWAP. And then, of course, I had to discount this Michigan consumer sentiment. Then I said, okay, we got the 10 o'clock bar in here. Let's see if it'll go back up and up. Once it pulled back up, if it went higher, game off. Was not going to trade it. We just couldn't trade it. But if it pulled back, we would take this little retest at the whole number at 95. And that's exactly what we did. We had the order here. We're looking at this around 95.40, 95.50. So if it gets to this area, we're in. Keep it a tight stop at 94, the red line, 94.50. It seems like it's $1, but it's only 50 cents. And normally what we do is we begin to add to this as it continued to move in our favor, not against us. We do have a strategy that we do add it to the ones coming against us, but they're more for more option scalp swing trades where you're going to be in it for a couple of days. It's hard to add on the downside too much on a day trade because it's hard to get out of, right? Even if it's stock with no theta. So this worked out beautifully well. Got out right there at $97. You can see to the left here. Just kind of draw the line. And that could have been anywhere from right there. Anywhere from $800 to $1,500, somewhere between, based on how your risk level was at that point in time. Stocks have been definitely, will make you think here a little bit. They've been coming at us hard and fast, and anything long, we think the market's going to bounce in this just major onslaught of selling in here. A lot of these early in the week did not work because you're going against huge selling, 10, 12, and one day $17 down in the SPY plus the gap. Incredible. You just can't fight City Hall and something like that. Well, today was the first day we had a normal, sort of normal day from what we're used to. And if you get the right stock on these gaps, you find them in here, look how they respond on the daily chart to 65, where they're gapping to above the 8. Or even below the 8, I'm just going to take it more shallow if I do. If it was below the 8, I would still take the trade, but I'm going to come out way earlier, or trail it way earlier because I'm going into the 8. And that usually is a pullback area as algorithms begin to kind of sell off into that moving average. So great trade. I wish I could say we do 4R every day, but the reality is all you need is this strategy is one of these a week, right? You can hold on to that $1,500 gain, have a $250 loss, $400 win, break even, $400 win, $250 or $1,250 win, $250 loss, $250 loss. You're dealing, that's probably about a $20 a month when you're dealing with those numbers. So again, it all starts with a larger time frame. You have to focus on the daily chart. Again, we exhausted our gap list. There were a lot more gaps than this on the list, but the problem was they were all gapping too high. I typically don't like to see gaps gapping north of 7%. Although some of them have been working lately, they've been running, but under these 7%, over about 1.5%, 2%. And I want to make sure that they've got reason to room, they're trading clean, they have a lot of volume in it here, how they're holding against the market in the sense of the pullback, are they relatively strong? There's a few different things that we're doing to try to go and drill down and funnel down and land on the precise stock. And Dell was the one, and that gave us a huge win. Now, we could have stopped at that and done very well for the day, right? And then we move into options trading, and we start looking at C, for example, in here. Now, we have a bull call spread on this. Now, why would he do a call spread versus maybe a put spread? Versus basically a straight call. There are a couple reasons why. Number one, well, you can reduce the price. So if you get a more expensive stock as you get into Ulta, maybe $200 stocks or more, the price of those are pretty expensive in the option. So one of the reasons that you do a bull call spread is that you're buying and selling in the same expiration at an out-of-the-money sell. So that reduces it drastically to your cost. If you got a $5 option, or let's say a $10 option, you probably can reduce that option to $5.50, $6. So it helps from that perspective. Sometimes if the open interest isn't there and the volume isn't there, you're too spready to trade. You have to go kind of straight call anyway. But if you're going out to the following month, that month or out to the following month on the third week in the options on Thursday, those you're going to find your best open interest and also your best volume stocks in there. So usually they'll keep the spread tighter in those. So C, great little move here. Microsoft, also a great move off the bottom. What's the pattern on this? A move down, a double bottom, and igniting from support. Same with, Coin kind of did that. It kind of pulled back though, so don't forget to show it. But the C kind of does that. And that's why I like here, double bottom at support, moving higher. The other caveat to this, I like to scan for stocks that are moving down at support. I don't buy them there, but I want to see how they respond to the 200. A lot of times on the retest of the 200, at its support area, if it's dominant to the left, I will definitely take that bar break on a lower time frame and try to catch the ride back up. I'm not looking for a V bottom by any means. I'd love to have it, but I'm not going to be in that long. I'm going to move this thing back to probably 21.6% of Fibonacci's, and I'm out. If I hit the 8 period moving after you first, I'm coming out there. So there's a lot of ways you can do this. So this is a type of plays when I'm adding to the risk. So for example, on a straight play on C, for example, I might only go in for a 10 or a third. So if you're doing a $5,000 risk, you might not be coming in for $1,700. If you got a $5, or $4 option, okay, so you can go in 4 contracts. If it pulls back, I'm going to add the 4. But here's the key. Don't wait too far to pull back, because then the whole pattern gets violated and you're adding to a red pattern. So there is some harmony in that when you're adding on these pullbacks. But once you add and become full in position, whether it be 2 pieces or 3, at the third piece going forward, you have to set that stop. And we're doing it by support, but I'm actually going to be doing it by percentage. So if we have a $5 option and I've added a third piece of the option at where I think the turn could be, we pull back 10 more percent on I'm coming out of it all. All in all, we shouldn't have more than about 25% of a loss in the option. So if you are trading, $1,000, it's not too much. It's about $250. So anyway, I hope this helps. There's a lot more that we talk about in Full Throttle Traders in our mentorship, things that we do on some Tuesdays and Thursdays, and daily recaps and things like that. So I hope this helped in some way. We trade technical analysis. So I'm not trading on hype. I'm not trading off what YouTube members say. I see all these YouTube people come out. They've been trading for 9 months and talking about they made $30,000 this month. I can't believe that's truthful. I'm not saying it doesn't happen from time to time, but there's usually about 10,000 losers to find those winners that they can post in there. So follow the money, follow technical patterns. To me, that's your best opportunity to win and be stable emotionally as you begin to kind of work your way through the metrics of trading. So hope this helps, guys. We'll see you in the room on Monday. Have a good weekend.